Let's turn to inflation now, notably wages and the services economy's inflation. The latest monthly inflation rate, this is for January, is due out Wednesday this week and surprisingly is expected not to fall but to increase. Now to explain, I'm joined by Warren Hogan, independent economist and a consultant with the small business lender Judo Bank. Warren, always good to have him in the program. Let's go to that monthly gauge. I know it's not the full thing that the quarterly inflation number is. It's a snapshot in many ways. But inflation going up is not the story we've been hearing for months and months now.
Yeah, no, we've had this disinflation, falling inflation for a year. The monthly numbers got a little ahead of the quarterly. So they were at 3.5% in December. The quarterly number was 4.1. So seeing this monthly number edge up a little bit really just brings it more into line with what we already know. I mean, the general accepted wisdom is inflation's running at around 4. Domestic services inflation, probably more like 4.5. So I'm not sure that the market will be too concerned by a small uptick this week.
But really, does it really matter in terms of where our inflation is now? It's heading down. The Reserve Bank basically thinks it's going to come into its target band sometime in the middle of next year. Life is okay. They're prepared to move ahead of it getting down to that band. That all screams that interest rates are going down later this year.
Yeah, and that is really the consensus, and that's widely held. And I mean, I sort of subscribe to that view largely, although I'm seeing more risks that the inflation may not come down as the RBA desires. They already have the slowest return to target of any central bank in the world, and they themselves have said they've got no room for that happening more slowly. And of course, the other thing is the wages figures we saw last week. They came in at 4.2, only a touch higher than what they were expecting at 4.1, but they are expecting that to be at a peak. It's going to come down from here. Now, that is not actually a forecast. That's a benchmark that the RBA is saying if wages do not stabilise and start to come down, we're more than likely going to have to hike again. And I think this is where all the risks in the market are right now.
You just said they're going to have to hike again potentially. So you're saying that, and this is certainly the line of the Reserve Bank, but everybody sits there and thinks, well, yeah, that's just there as a bit of insurance. It's not necessarily what they think. You're saying there is still the prospect that the Reserve Bank could raise interest rates yet again.
I think it's a 1 in 3 now, up from 1 in 4 at the start of the year, and it's very closely becoming the central case.
And that is because inflation has now become entrenched. This is not imported inflation, as the government likes to say. This is actually homegrown inflation that's baked into wages, that's baked into the services economy.
It is domestic inflation. It's wages at 4 with no productivity growth. If productivity suddenly picked up to 1.5, then you could get inflation down to 2.5. But we're seeing no evidence of that. And the other thing I'd note, this economy is looking better this year. It started 2024 on a firmer footing. And of course, if the economy starts to pick up and inflation hasn't retreated, well, we can be pretty sure that the Reserve Bank's interpretation of that is that inflation could rise down the track because it's a lagging indicator.
And there's a second aspect of this. You've got to look back 12 months and see what was happening 12 months ago, because when we come up with our inflation rate today, it is what prices and goods and services are doing today versus 12 months ago. Now, if prices were already falling pretty hard 12 months ago, it doesn't take much to actually see inflation actually staying higher than the Reserve Bank might expect.
Yeah, and that's it. And that's the stickiness. And of course, that's the wages, but it's also an economy that's going through the softest of soft land.
OK, so what do you say about the Treasurer last week and the Prime Minister celebrating the fact that wages, real wages, are going up now, that wages growth is higher than the inflation rate? They were celebrating this. Every business leader around the country would be absolutely loathing that, I would have thought.
Well, I mean, look, 4% wages is fine. If inflation continues to come down towards 2.5, then you get real wage increases. That's the world we want to be in. That's the world we're in pre-COVID.
But that's not where business wants to be, surely.
Business has got 2 problems right now. Not only is labour very hard to find and there's upward pressure on wages, that's not going away. There's nothing that tells us wages are coming down. But the other thing is there's non-wage labour costs, everything from work from home to flexibility to other ways to attract staff. Every business I speak to this year, end of last year, cost pressures are not abating at all. And of course, that is going to maintain pressure on them to pass it on to final prices, i.e. inflation, so long as they can. And that's all going to be a function of the health of the economy.
So there's a risk of higher rates, but your base case is still that rates fall later this year.
Very close to calling for a rate hike probably in June. It won't happen quickly, but they may get dragged back into another 50 to 100 points of rate hikes middle of this year.
Warren Hogan, always good to have you in the program. Many thanks for your time today.